Today is the third of 6 lectures on the development of modern Japan. The topic of today's lecture is Japan's economy. Industrialization, which ushered in a new era of global history, originated in the West. During the 19th century, membership in the so-called industrial club was small and exclusive, reserved only for Western powers. But in the first half of the 20th century, Japan managed to break into this exclusive Western club of industrial nations. Following the end of the Pacific War, when Japan's industrial infrastructure was demolished, Japan once again embarked upon industrial development, reconstruction, reorientation, and a further development of its industrial infrastructure. Once again, Japan succeeded magnificently in rebuilding its economy, its industrial infrastructure, and took its place by 1975 as the second largest economy in the world, behind the United States. How was it and why was it that Japan, among all of the other nations outside of the West, managed to industrialize? What was the secret of Japan's success? What factors explain Japan's pioneering economic accomplishments? Well, looking into the historical lens, you can see that in the mid-19th century, when Japan was radically, forcibly opened up to the West, Japan had a very strong national motivation to industrialize, namely to forestall colonization, occupation, and conquest. So one of the reasons that Japan succeeded early to become an industrial economy was the national security crisis that faced Japan. It looked all around. It saw that China, its giant neighbor, was being carved up by Western colonial powers. It saw that other parts of Asia, Indonesia, for example, parts of the continent of Asia were being colonized, and it feared that the country of Japan itself would be subject to colonialization and domination. Therefore, in order to prevent that from happening, in order for Japan to preserve its independence, its national sovereignty, economic development, industrialization was the necessary condition. In the mid-19th century and into the early 20th century, Japan also benefited from the fact that it was a latecomer. It was catching up to countries like England and the United States and Germany. This latecomer status meant that Japan had an idea of what it would take to industrialize. There was a blueprint already in the experiences of the Western states to follow. And therefore, Japan was able to benefit from latecomer perspective, understanding what had to be done and proceeding to implement what had to be done. So latecomer status, both in the mid-19th century and also in the mid-20th century, when Japan had to rebuild again, was, I think, one of the big reasons for Japan's success. Another reason, I think, is that Japan was an island archipelago with a sense of nationhood, of national identity, a homogeneous nation, a distinctive nation that was able to mobilize in the effort to develop an industrial infrastructure. In this effort, the state played a critical role. The first instance and the second instance of Japan's industrialization saw state-led development. That is, the government playing a key role in a top-down fashion in developing a strategy and helping to implement that strategy, creating the kind of institutional framework for Japan's industrialization. Only the state in industrialization has the resources, the authority, the power to mobilize, for example, large amounts of money, capital, necessary to build steel factories, to create a steel industry, to develop a shipbuilding sector. These areas require massive amounts of capital, and in an early developing country like Japan in the late 19th century, there wasn't that capital available on private markets, and so the state played a critical early role in the development of heavy manufacturing industry. It also played a role in the building of transportation infrastructure, railroads, subways, ports, airports, facilities that enable transportation to take place both within Japan and between Japan and the outside world. So the state played this critical role in such a way that it can be called a state-led pattern of industrial development. Of course, the people also were a critical factor. Just as the state had a top-down implementation strategy, there was a bottoms-up energy, power, ability that was provided by the Japanese people. In the mid-19th century, male literacy in Japan was already substantial. And of course, right after the end of the Pacific War, by 1945, and afterwards, Japan had universal literacy with the universal mass-based educational system. And not only were the people educated, but they were energetic, they were ambitious, industrious, committed to their work, and capable of unleashing an enormous amount of energy necessary to build an industrial economy over a generation of time, 30, 40-year period of time. High ambition, high aspirations, high levels of energy characterize the Japanese labor force. And without that, Japan would not have been able to industrialize. There was a culture of hard work and frugality that was built into the Japanese society. And several sociologists have recalled this, the equivalent of the Protestant ethic, so famous in the West, the Protestant ethic being the notion that workers, in order to show that they were among the those that were blessed by divine salvation, proved their selection by working hard, saving money, and showing that they were actually worthy of this salvation. In Japan, without this ideology or this theology, Japan nonetheless had a very strong work ethic and industriousness and frugality that was built into its ethics and culture. And finally, let me mention that in both the mid-19th century and the mid-20th century, there was substantial leeway for economic growth. Because Japan was a latecomer, Japan had the necessary flexibility, the degrees of freedom to develop in a rapid fashion. For example, the workforce in mid-19th century Japan, 80% of the workers were farmers. And as Japan developed shipbuilding industry, steel industry, and so forth, the workers from the farms could be shifted into work in the manufacturing plants, work in the service sector. And this shifting of labor from the primary sector of farming and fisheries to the secondary sectors of manufacturing and assembly, and the tertiary sectors of the services, this shift of labor meant that workers had a higher and higher output. And this leeway is one reason why early developing economies like Japan in the mid-19th century and in the mid-20th century have the flexibility for rapid development. We see that in China today, we see that in India, we see that in Indonesia. Shifting of labor and capital from the primary sector to the manufacturing, assembly, and service sector. And that's exactly what happened in both cases. Now, in the second case, that is the mid-20th century, Japan also had the benefit of starting afresh, tabula rasa. Because the war turned out to be a devastating defeat, which destroyed more than 60% of Japan's physical infrastructure, Japan was able to launch industrialization, having had the prior experience in the late 19th century and early 20th century of industrialization. Not only did it have the prior experience of industrialization, but it also learned the lessons of the Second World War. And it focused on economic development, not on military power. And this decoupling of economic growth and military power is one of the keys to the acceptability of Japan's industrial development in the second half of the 20th century by Asian neighbors that suffered from Japanese aggression. Not only was there lessons learned, but also Japan entered in the mid-20th century into an open, progressively open, peaceful, stable, growing international economy, international system. This was an international economy that was built on the notion of openness and free trade. And into this international system, Japan was accepted in the 1960s. It became a member of a number of international organizations and regimes, and it was able to benefit from the stability of this international systemic framework of open trade. And then let me finally mention that common to both mid and 19th and 20th century was that Japan enjoyed political mobilizability. In the mid-20th century, this mobilization was made possible by single-party domination, single-party rule of the Liberal Democratic Party, a very strong bureaucratic administration, and a coalition of interest groups that supported the LDP, the Liberal Democratic Party, and the government as a whole. So here were their common threads, therefore: latecomer startup, the blueprint of action, implementation by the state and private sector of this blueprint, a young, energetic, ambitious, and frugal workforce, highly educated, learning on the job, and acceptance by the international system in the mid-20th century. Let me now turn for the rest of this lecture on the 20th century experience. Japan's development from 1952, the year that it recovered its independence, through until roughly 1992, was one of the most remarkable events in the second half of the 20th century. Japan once again showed a vibrance, a robustness to its economic performance that few other countries in history had been able to show. Indeed, Japan developed what can be described as a new model, a new paradigm of industrial development. I have called this SEID, S-E-I-D. SEID is an acronym which means state-led, S, export-oriented, E, investment-driven, ID, I, development, SEID, S-E-I-D. This is the model that Japan put together and implemented to grow more rapidly than any other country in the second half of the 20th century. The characteristics of this SEID model are as follows. First, it's state-led, as I mentioned. The state plays a major early role. It is nation-centric, that is, it is focused on the development of the national economy. It is internationally instrumental, that is, it looks around at the world and it finds things that will help it to industrialize. For example, technology, advanced technology in the West that could be borrowed, bought, and then adapted to the Japanese industrial structure. And indeed, Japanese companies borrowed advanced technology, paying royalty fees, and applied them to their factories, steel factories, shipbuilding factories, automobile factories, and improved on them. That's the key. Constant improvement, and improvement in the process area, in the non-glamorous areas of manufacturing, processing, assembly processing, so that many people have heard about the just-in-time system of supply, where auto companies get parts and components from suppliers, small companies, just in the nick of time as they're assembling the automobiles. And this saves a lot of cost and difficulty in warehousing components. So just-in-time inventory processing is one example of the kind of process technology that was part of this SEID model. Exports. This SEID model would not have been possible without a major thrust of selling to the outside world. The Japanese market in the mid-20th century was not big enough to sustain major industrial development without advancement into markets overseas, particularly the United States and Europe, which were the two biggest markets in the world. So that export was a major part of the catalyst, accelerator for Japan's industrial development. And here the Japanese emphasize, the Japanese private sector, the companies, market share maximization, not profit maximization like many Western companies. The idea was that you go in and you sell products, let's say copiers, at a low price, below the price of your competitors, maybe at cost. And the idea is over time, as you build volume of production, the cost of each unit drops. So that over time, if you sell enough copiers, the price of the copiers will drop because the cost of producing those mass copiers will drop. Automobiles, the same way. So Japanese companies had this market share maximizing strategy, which was a winning strategy in many global markets, and became very big in major sectors of the industrial economy, including consumer electronics and automobiles. The export thrust meant that there was a surplus of trade. And really beginning in the late 1960s and expanding into the 1970s and picking up speed in the 1980s, Japan enjoyed a surplus of trade. That is, it sold more overseas than it imported from overseas. Basically, it imported raw materials, energy, oil, for example, gas, and it exported manufactured goods, stereo systems, automobiles, and so forth. And the surplus of trade meant, in essence, that it would grow over time and lead to a current account surplus. A current account surplus is the trade balance, which was in surplus, plus the financial balance of investments that were made overseas and investments that were made in Japan. And as a result of these surpluses in trade and current accounts, Japan had a rising amount of foreign currency reserves in its countries. That is, it had dollars that it could hold as reserves. And in the 1980s and 1990s, it bought a lot of US treasuries to help finance the exports that it sold in the United States. What this meant from a Japanese point of view was that it had the risk and eventual reality of yen appreciation vis-a-vis the dollar. That is, the yen grew stronger and the dollar grew weaker over time, which means that the value of their dollar holdings, the value of the dollar reserves, diminished over time because the value of the dollar was weakening relative to the yen. But this was part of this SEID package which the Japanese were willing to sustain because the overall paradigm was so effective for the Japanese. The model also included high and sustained private household savings, so that the average family in Japan in the mid to late 1970s into the 1980s would save 18, 20%, in some years 25% of their disposable income, and put that savings in banks and into postal savings accounts. And this massive accumulation of savings meant that over time, the banks had ample money to lend to corporations, which would borrow money and invest in new facilities and the expansion of their business. The postal savings system, which also held huge amounts of household savings, recycled that money back into supplemental budgets for the Japanese government, which allowed the government to invest in transportation and energy, telecommunication infrastructure. So the household, in essence, subsidized, financed Japan's industrial development. It provided the capital that corporations needed for investments. and investments were a huge part of Japan's economic development, capital investments. And it not only provided taxes to the government, but also the savings in the postal system was recycled through supplemental budgets that helped the government function. So this recycling of capital from households to the corporation and to the government was a big part of this SEID model. Thus, you can say that this model was dependent on large-scale demand generated by capital investments, government spending, consumer spending, which was lower than most other countries, around 50 to maybe 58% of GDP, and foreign demand. So this was the kind of paradigm that Japan followed for the second half of the 20th century. And the priority in the SEID model was placed upon producer groups and the state. That is to say, it was placed on corporations, it was placed on government, public corporations and entities, and the consumer, the individual consumer and the private household, largely speaking, was subordinate to the priorities of the producer groups in the Japanese economy. But this is not to say that the consumer groups and the households were exploited. On the contrary, this was a voluntary system, and the households and citizens benefited in the long run by having increasing disposable income, higher wages, and from 1955 until 1975, every 6 or 7 years, wages, household disposable income doubled, so that there was growing wealth for the household that was made possible by the recycling of their savings to the private sector corporations and back to the government. And there was a remarkable degree in Japan of equity, equality, in the recycling of income and wealth. If you look at the standard indicators of income equality, the Gini coefficient, as it's called by economists, Japan scored better in those dimensions than the United States or even the Scandinavian states, which were dedicated to welfare. So in some respects, the SEID model combined very rapid industrial growth with equity in the distribution of income and wealth. It was a remarkable combination. And the SEID model, which the Japanese originated, has outperformed other types of models in the second half of the 20th century. From 1961 to 1972, for example, Japan's economy grew at 8 or 9% per annum. And from 73 to 90, around 5% per annum. Remarkable, steady, sustained rates of growth, historically unprecedented. And since 1990, really even before then, this Japanese model, SEID, has been diffused to Taiwan, to Singapore, to South Korea, and now to China. And Japan was a catalyst of rapid regional growth throughout Northeast and Southeast Asia. Now, along the way, from really the mid-1980s into the 21st century, Japan, this SEID model began to malfunction. In 1980, in the mid-1980s, Japan was seen by the outside world to be a remarkable, almost invincible economic juggernaut. That is, a machine that was constantly churning out, expanding output, and going into more and more markets, into more and more sectors, and dominating those areas. And in the United States in particular, in the mid to late 1980s, there was a fear that Japan would overtake the United States as the #1 economy and displace American corporate leaders in automobiles, in consumer electronics, in pharmaceuticals and biotechnology, in finance, in many areas that were critical to the functioning of the US economy. There was this fear that Japan would become the leader, the #1 producer in the world. But along the way, Japan stumbled. And in 1990, it entered into what is known as 2 lost decades. 2 decades basically from 1991 until 2012 of stagnant economic growth, around 1 to 2% growth over this 20-year period, and a severe drop in asset value, a drop in real estate value, drop in stock market value, from which Japan has not really recovered, and strong deflationary headwinds, that is the grip of deflation, not inflation, making the escape from this stagnation very difficult. What happened during these 2 decades, from 1991 basically to 2012, was that China in particular, but the United States too, continued to grow. And the United States opened up a bigger gap with Japan, which up until then had been closing the gap in size with the United States. It had become 60% the size of the United States with half of the population. Then it began dropping off, and it's now less than half of the size of the United States economy, again with less than half of the population. But China, which was behind Japan in 1991, has now overtaken Japan as the 2nd largest economy in the world. So there was a big opportunity cost in the lost 2 decades for the Japanese economy. And during this period of time, there were serious, still unresolved structural problems in the Japanese political economy. The most notable is a very high level of national debt. National debt in Japan is about 200% of GDP. That is twice the amount of output of its national economy. In the United States, which also has a very big national debt, it's probably around 93, 95%, about half the level of Japan. All industrial democracies have a generic problem of very high debt. And that's part, I think, of this industrial democratic system where the people expect and demand increasing government services, entitlements, social security, healthcare, welfare, investment in infrastructure and education, and yet are unwilling to pay for the costs of those services and entitlements. So that the net result is that you have a growing deficit in virtually all of the industrial economies. In the case of Japan, this debt level, 200%, is staggering, but only a 5 or 6% of it is held by foreign entities. In the case of the United States, over half of its debt is held by foreign entities, by the Chinese, by the Japanese, and by other foreign entities. But in Japan's case, it's almost all internally held, domestically held. So it is not as worrisome for the Japanese government as the American debt is for American political leaders. Nevertheless, debt servicing, that is paying the interest on this 200% of national debt, now represents in Japan 55% of all tax revenues. So all the taxes that the government collects, 55% of it goes to the payment of the interests and some of the principal of this national debt. That means that only 45%, and that's a shrinking percentage, of that taxable income, the tax revenue, is available for other services in the case of Japan. This is an unsustainable level of debt. Japan has reached the point where it must find ways to curtail the debt, scale it back, and be able to grow at a robust rate. The aging population is another serious problem, and I'll talk more about that. And the malfunctioning of the political system is yet another major structural problem in Japan in the 21st century. What were the reasons for the slowdown of this once dynamic, almost invincible economic machine, the SEID model? Well, the reasons for the slowdown are, first, a lack of effective political leadership. There were serious policy mistakes that were made. These mistakes go back to the late 1970s and early 1980s into 1990, where the Ministry of Finance, the Bank of Japan, and the Liberal Democratic Party allowed a massive speculative bubble to blow up in Japan. So much money was being poured into real estate speculation. Banks were lending to corporations, to individuals, to buy real estate. And there was a feeling that real estate had collateral, physical collateral, that is buildings and land, and that they had always appreciated over time and that they were therefore safe. But the value of real estate in Japan got to be so bloated that sooner or later it was bound to be popped. Just the small area of the Imperial Palace, the small plot of land in central Tokyo where the imperial household resides, became worth the entire state of California at the height of this real estate bubble in Japan. It got to absurd levels, and it had to be, it was bound to burst, which it did. And so the government allowed, through policy mistakes in the late 1980s, allowed this low interest environment, cutting interest rates, pumping more money, allowed this bubble to balloon. And once it popped, it was not able to deal effectively with the problems that ensued. It did not deal with the banking crisis until 8 years after it appeared. It did not deal with the non-performing loans, which were a massive amount of money, really until the 21st century. And it did not really institute the reforms that were necessary to kickstart the Japanese economy. And even those reforms that were implemented, such as postal system reform by Prime Minister Koizumi, were reversed very soon after. Furthermore, the SEID model, the SEID system, allowed the what we call zombie companies and zombie loans. That is, companies that really ought to have gone bankrupt and no longer viable, and loans that ought to have been written off or partially paid back. These zombie companies and loans to continue because the government did not want to have a rash of bankruptcies that would bring up unemployment rates and would cause serious adjustment problems in the short term for the Japanese economy. So instead, banks continue to roll over bad loans, companies continue to operate, plants and facilities continue to operate at below capacity. And so there is, in short, an inefficient allocation of capital and labor in Japan. It's still inefficiently allocated, and if they had allowed the market, what we call creative destruction, to clear away the non-competitive segments of the Japanese economy and to reallocate the capital and the labor, Japan would be in a much better position now. The private sector also, over time, had grown big, slow, clumsy, and risk-averse. And in many sectors of the Japanese economy, even sectors where Japan had been global leaders, there was a failure to adapt to the new circumstances of economic stagnation. And there was what many people have called the Galapagos effect. That is the effect of following policies, practices that isolated Japan from the rest of the world economy. Then the aging of the population and the labor force is a very serious issue. Japan has gone from 1945 to 2012 as one of the youngest populations in 1945 to the oldest population in the world in 2012. In 1950, about 5% of the Japanese population was 65 years or older. Today, 2012, it's about 25%. So it's the number of senior citizens, 65 years and older, has quintupled over the course of the post-war period, from 5% to 25%. By 2050, the midpoint of this century, the Japanese senior citizens category will be about 40% of the Japanese population. Imagine that, almost half of all citizens in Japan will be senior citizens, most of them retired, 65 years or older. So the labor force has been inverted from a pyramid of very young workers at the bottom to older workers at the top, to an inverted pyramid, older workers at the top supported by a dwindling base of young workers in the prime of their labor productivity. And the aging of the Japanese population means that the government will continue to have a heavy burden for Social Security, for health care, for other areas of welfare. Not only is the population aging, but it is shrinking because there are not enough Japanese babies being born every year. The fertility rate in Japan has fallen from 4.5 in 1947, that is 4.5 children per couple, to 1.2 by 2004. It's probably around 1.1 today. 2.2 children per couple, per family, is replacement. That is, it's steady state. It allows the population to continue at its size. But over time, if it's 1.2, it means that the Japanese population is shrinking. Taiwan is 1.1 fertility rate. Sweden is 1.7. They're both below the steady state level. France is 2.2. The US is a little bit above 2. So there is a steady shrinking of the Japanese population. And today, with 127 million people, Japan is the 10th largest in the world. But by 2050, the midpoint of this century, Japan's population will be 109 million, down from 127. And by the end of this century, by 2100, if nothing else changes, Japan's population will be 64 million. A huge drop, about half of the current population of Japan. 64 million is or was the size of Japan in 1930. 64 million is roughly the size of France and the United Kingdom today. So Japan, unless it changes its immigration policy or unless it steps up its fertility rate, is an aging and shrinking population. So let me turn next to the viability of the so-called SEID model of economic development. The impact of Japan and other Asian countries now, South Korea, Taiwan, China, has been both positive and negative. Very positive in the sense that the rise of industrial Asia, particularly the rise of Japan and China, have had a very positive impact on the growth rates of the world economy. Asia has become the fourth engine of growth. If you add Japan and China and the rest of Asia together, India coming on stream as well, this is going to be the biggest engine of growth in the world in the 21st century. Asia's rise has also allowed a global division of labor, much greater labor efficiency and productivity. And many of the major multinational corporations in the United States and Europe are now outsourcing manufacturing, assembly, and other services to the low-cost areas of Asia. And Asia is a critical component, maybe even in some senses the foundation of the international supply chain. And this has led to lower costs of production, lower prices, and greater productivity. Japan's development, South Korea, Taiwan, the democratization of South Korea and Taiwan, a remarkable accomplishment, and China's rapid economic growth were all factors, in my view, in the triumph of the West, the triumph of capitalism over the East, over communism, the Soviet Union in the Cold War. And so this was a dramatic event in world history. But there are also negative consequences. And these negative consequences include, for example, the global macro imbalance. That is to say, with huge amounts of Asian exports flooding into the United States and other markets, and insufficient demand in Asian markets, Japan, South Korea, China, for example, that means that there is a distortion in the capital flow. Capital flowing from Asia into the United States and the West, where they use that money to purchase goods and services from Asia. And this distorted imbalance is one which may or may not be sustainable for a long period of time. And it is one of the reasons why I think we had a crisis, a financial crisis in the year 2008. It was a structural factor that made this kind of problem structurally difficult to prevent. So we have Japan now at a crossroads. I've mentioned already some of the very serious problems that it faces, particularly the problem of its national debt and the problem of its aging and shrinking population. It still has substantial national assets to draw upon. Manufacturing know-how, a manufacturing infrastructure which is second to none. It still has massive liquid assets, household savings and corporate savings amounting to $12 trillion, which can be utilized for Japan's eventual escape from economic stagnation. And it has domestic sectors of potential high growth. Tourism, for example, is a big area. As Asia develops and grows, more and more tourists will come from Asia into Japan. Healthcare is another big area of future growth for the Japanese economy. And perhaps the biggest is global infrastructure, the boom in the creation of infrastructure, transportation, energy, telecommunications in the emerging markets of Asia. It's estimated that this market by the year 2030 will be $4 trillion, larger by far than the market for automobiles and consumer electronics. Japan happens to be strong in these areas of energy, telecommunications, transportation. Even though it's not experienced globally in those areas, it has an opportunity to enter these Asian emerging infrastructure markets and to generate economic growth there and in Japan itself. The major issue, however, in my view, is whether in order to escape, spring out of this economic stagnation, the last 2 decades, Japan has the necessary political vision, the political courage, and the political know-how to lead the country out of the 2-decade-long economic wilderness. This is the question which in the last 20 years has not been answered. It is a generic question for all capitalist democracies. In times of economic adversity, and we are definitely, the world is in a time of economic uncertainty and adversity, do these capitalist democracies, including Japan, the United States, and Western Europe, do they have the political vision, do they have the political courage to lead the countries, their countries, and the world economy out of the grave problems that now beset it? What's happened over the past several years, particularly since the 2008 financial crisis, is that the incentives for political leadership have been for bickering, for partisanship, for dithering, for delaying, for not tackling the big questions and problems. And the net result is that there has been a spread of these economic problems. The Eurozone crisis, the national debt problems in the United States and Japan, the possibility of another big financial earthquake, and what will be required in the industrial democracies is bold leadership,